This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 21, 2026, and this is the Tokyo session. Now, let's get into it. The yen just hit a 40-year high against the dollar, flipping the script on carry trades and sending safe haven flows into overdrive. As of 2013 Eastern Time, dollar-yen is trading at 162.482, having breached the psychological 163 mark amid escalating Middle East tensions. We are looking at a market defined by fear, with the fear and greed index sitting at a dismal 14 out of 100, while gold climbs to $4,047.94. Today's economic calendar is relatively quiet in terms of major data releases, but the schedule includes U.S. weekly jobless claims on Thursday, July 23rd, followed by dollar GDP Now estimates on Monday, July 27th, and Tuesday, July 28th. These figures will be scrutinized for signs of labor market cooling versus persistent wage pressures, especially as the Federal Reserve holds the funds rate at 3.63%. While inflation metrics like June CPI sit stubbornly at 3.46% year-over-year. The broader market snapshot paints a picture of aggressive risk-off positioning. The U.S. dollar is strengthening across the board, with the trade-weighted dollar index up 0.20% week-over-week to 120.53. Meanwhile, equities and yield-sensitive currencies are retreating. The VIX is at 18.77, up 2.04 points, though it hasn't reached crisis territory. The dominant theme is clear. Capital is fleeing emerging markets and European cross-currency pairs, concentrating instead in the US dollar, Swiss franc, and physical gold. Let's look at the headlines driving this move. First, oil Isami Houthi blockade threat forces Saudi crude tankers to turn back. Second, dollar-yen hits fresh 40-year high above 163 as equities, yields, and oil all gain. And third, Iran says all U.S. and allies' interests in the region will be targeted if U.S. attacks nuclear sites. These aren't background noises. They are the direct catalysts for the flows we see right now. The macro implication here is stark. We have a perfect storm of geopolitical supply shocks and monetary policy divergence. The ECB is expected to hold rates in July, but hint at a September hike, according to ING, while the Bank of Japan remains silent. This silence from Tokyo, contrasted with the Fed's sticky inflation print of 3.46%, creates a structural void that is being filled by dollar demand. The fear index, rising from 12 to 14 over 7 days, tells me this isn't a flash event. It's a sustained repricing of risk.
Technically, the structure on dollar-yen is broken. We saw the price close at 162.482, well above the 5-day high of 162.600 established earlier this week. That breach of the 163 psychological barrier confirms a break-and-hold pattern. The 5-day range of 161.982 to 162.60 shows higher lows, indicating that institutions are absorbing liquidity on dips. There is no deep retracement here. Sellers are exhausted.
And that exhaustion is dangerous for those holding the wrong side. Look at the COT data. Leveraged funds have a net short of negative 90,461 contracts in yen. That is a massive concentration of risk. They bet on stability while the Houthi threats turned real. Now, every tick higher in dollar-yen forces them to cover. It's not just directional, it's mechanical. The short interest of negative 53,691 in the euro follows a similar logic, though the euro shorts are slightly less crowded than the yen shorts.
But I'm concerned about the disconnection. The VIX is at 18.77. That looks benign. Yet the fear and greed index is at 14. You don't need a VIX above 25 to see capital flee to safety when tankers are turning back. The options market is pricing in a slow bleed scenario, ignoring the acute tail risk visible in the spot FX flows. We are seeing a decoupling between implied volatility and realized fear. If the Houthi blockade tightens further, that 18.77 VIX won't capture the pain. The spot currency pairs will scream it.
Let's dig deeper into the dollar-yen dynamic. Grid, you mentioned the break of 163. What does the chart tell us about the sustainability of this move?
It tells us the breakout is genuine because of the volume profile. From July 17th to 20th, we saw the price consolidate around 162.128 to 162.202, establishing a firm base. The move to 162.482 wasn't a wick, it was a closure. The next structural level to watch is the 162.40 resistance cluster, which has now become support. Failure to hold this level would suggest a fake out, but the current candlestick structure argues against that. We are in a trending environment, not a ranging one.
Agreed, but let's talk about the counterparty. Who is buying this 162.482 level? It's primarily asset managers rotating into dollar longevity, while leveraged funds are desperately trying to exit their negative 90,000 contract short. The weekly delta on those yen shorts increased by negative 91,732. That means the short squeezing is accelerating. If the Houthi news cycle worsens, that delta goes higher, and the buy-side liquidity dries up because everyone is chasing the cover orders.
Which brings us back to the policy divergence. The ECB is holding and hinting, but the Bank of Japan is silent. In a normal world, this widens the yield spread in favor of the dollar. But in a risk-off world, where oil is climbing due to the Houthi threat, the Japanese economy, which relies heavily on energy imports, is structurally disadvantaged. The Bank of Japan cannot tighten without crashing their import costs further. So, the silent Bank of Japan is actually a tacit admission that they are powerless to defend the yen against these external shocks. That's why the fundamental bid for dollar-yen is so robust.
I'd push back on the idea that the Bank of Japan is simply powerless. The issue is that the market is front-running the collapse of the carry trade before the central banks even blink. The VIX at 18.77 suggests traders think there's enough room to maneuver without triggering a margin call cascade. But with the fear and greed index at 14, the margin for error is gone. The risk isn't just that dollar-yen goes higher. It's that the liquidity in dollar-yen evaporates because the counterparties, the ones holding those negative 90,000 shorts, run out of collateral. That's the shadow in this trade.
Shifting gears to gold. It's up nearly 1%, trading at $4,047.94. How does the technicals view this alongside the FX move?
Gold is validating the FX breakout. It's trading just $13 below its 5-day high of 4,061.25. The key level here is the psychological floor at 4,000. The July 20th close was 4,009.97. As long as gold holds above 4,000, the momentum is intact. The proximity to the high suggests buyers are stepping in aggressively on any dip. It's a classic safe haven bid, mirroring the dollar's strength but with a tangible asset premium attached.
The flow data supports this. We're seeing a rotation out of yield-bearing assets and into physical stores of value. The same institutions dumping RC yen are adding to gold longs. It's a diversification of the safe haven basket. They aren't just buying dollar. They are hedging the dollar's purchasing power against the inflationary spike caused by the oil disruption. It's a dual play, long dollar/short yen and long gold.
Just remember, gold at 4,047.94 is testing resistance. If the VIX doesn't spike, gold might face profit-taking. But given the fearful sentiment score, that profit-taking might just be rotated back into the dollar. The risk here is a liquidity trap. If the Houthi situation stabilizes suddenly, gold could retrace quickly to the 4,100 level. But for now, the fear premium is holding it up.
Let's look at the euro-dollar pair. It's down slightly to 1.1413. What's happening with the euro?
Euro-dollar is struggling. 1.1413 is dangerously close to the 5-day low of 1.14024. The structure is weak. Every bounce seems to get sold off immediately. If it breaks 1.140, the next support area is 1.1380. The DXY strength is capping any upside. Technically, it looks like it's searching for bottom, but the downtrend is intact.
The positioning confirms the struggle. Leveraged funds are net short euro by negative 53,691. That's a heavy bet against the single currency. Combined with the ECB's cautious stance, there's little incentive for big money to defend the 1.14 level. The flow is consistent, short euro, long dollar.
The ECB's hint at a September hike isn't enough to offset the geopolitical risk premium attached to the Eurozone. Europe is closer to the conflict zone than the US. Energy insecurity weighs on the euro far more than it weighs on the dollar. So, while the Fed is dealing with domestic inflation, the ECB is fighting a losing battle against imported inflation and political uncertainty. The divergence is widening. Finally, let's touch on the commodity currencies, specifically cable and Aussie yen. Cable is at 1.3437, while Aussie yen is at 113.8245.
Cable hit a 5-day high of 1.35444 on July 16, but has since compressed to 1.34374. That's an 11 pip contraction, or wait, checking the data, that's an 1100 pip contraction from the local top. The rejection at 1.35444 is significant. It suggests the risk-on rally failed to sustain. The chart shows a descending channel from that high.
Here's the interesting divergence. While yen shorts are exploding, Aussie longs are actually increasing. Leveraged funds are net long Aussie by positive 27,222. That's a bit counterintuitive given the risk-off environment. It suggests some players are still believing in the Australian dollar's commodity link, perhaps betting on a rebound in iron ore or Chinese stimulus. But with Aussie yen at 113.8245 and falling, that long Aussie position is getting squeezed by the stronger dollar and weaker yen simultaneously.
That Aussie long position is risky. Positive 27,000 is not small. If the Houthi blockade disrupts shipping routes affecting Asian trade volumes, or if China's economic data disappoints ahead of the GDP now estimates, those Aussie longs could unravel fast. The carry trade is unwinding, and anyone holding onto the hope that commodities will save the day is ignoring the immediate liquidity crunch in the funding markets.
So, tying this together, Grid flagged the technical breakout in dollar-yen above 162.40, which CIPHER confirmed is being driven by a massive negative 90,000 contract short squeeze. Pulse highlighted the policy divergence, where the ECB's caution meets Bank of Japan's silence, leaving the dollar structurally favored. SPECTER warned that the VIX at 18.77 masks the acute risk in the spot flows, meaning any further geopolitical escalation could accelerate that squeeze. And on the flip side, the compression in cable and the vulnerability of Aussie longs suggest that the risk-on assets are thoroughly out of favor. The consensus view is clear. The dollar is the winner, the yen is the loser, and gold is the hedge. But the speed of that loss depends entirely on whether those leveraged funds run out of capital to cover.
To summarize the session, dollar-yen has broken its 40-year high structure, supported by both technical momentum and a massive COT short squeeze. Gold is holding above 4,000, acting as a reliable safe haven alongside the US dollar. Meanwhile, European and commodity-linked currencies are underperforming due to policy confusion and risk-off flows. The market is pricing in prolonged geopolitical tension, with the fear and greed index reflecting deep anxiety, despite moderate volatility readings. Tomorrow, keep an eye on the US dollar's reaction to any updates on the Houthi blockade and the upcoming jobless claims data for clues on labor market resilience. This is ShadowQuant Forex edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the London session, where we will see how these calls play out. Until then, trade safe.